Coming to you live from Concenture's World Headquarters right here in Houston, Texas. Actually coming to you from my office. As always, once a quarter, we're so lucky to have the CIO of Sanctuary Wealth, Jeff Kilberg, here to kind of give us a market update and kind of share some of the thoughts and some of the thinking that are kind of coming on. Jeff, thanks for joining us. We always appreciate it, and clients love to hear what you have to say. So here we are. First quarter's over. What? It's been kind of crazy.
It has, Robert, and as always, a pleasure to be here talking to your clients. Can't wait to get back down to Texas, see you again here soon. But what's interesting is when we talked last time, we really talked about the anticipated increase in volatility. And certainly that came and kicked us in the teeth. We saw the VIX. We talk about the VIX a lot on CNBC. That measures option premiums, and more importantly, it's like a fear gauge. We saw the VIX, which we kind of hung out in the teens. It went from 15, 16. Most of 2021, all of a sudden it popped over 40. So this higher VIX certainly caused a lot of problems. And we did speak also about the midterm election year. That midterm election year is typically fraught with all types of volatility. We didn't know volatility. No one predicted that Russia was going to invade Ukraine. But nonetheless, as we closed out the quarter last week, it was interesting to see equities kind of healed. We didn't really get any geopolitical remedy, right? We're still seeing, no one's trusting Putin to really stop doing what he's doing over there. But that geopolitical tension, that flared up equities. We did see a great price discovery in the S&P 500. I know it didn't feel good on the way down, but nonetheless, I think that was really important to see that price discovery. The S&P went down under 4,200. We found some buyers down there. We found some stabilization. I am not diminishing by any means all the headwinds from inflation to treasury. We're going to talk about all this today, but all the headwinds out there. It is interesting to see that the undercurrent in the market, specific to the U.S. stock market, has been pretty impressive and so resilient. So here we are kicking off the second quarter. I believe a lot of the themes that we saw in Q1 will persist in Q2, but it goes back to the fact that I'm more optimistic and constructive than most of Wall Street.
Right. So, probably a big reason for the bounce right there is people have a lot of cash, right? Managers have a lot of cash. That kind of provides a bit of a safety net. Jeff, I got to tell you, the things that clients are concerned about and asking us about that I really would love to have your thoughts on, and we kind of do this kind of in order, is number one, wasn't that long ago, I drive an F-250. It wasn't outrageous for me to have to fill it up. Now it's a 2 credit card deal because everyone has limits. Tell me, what's the outlook? What should we be thinking about inflation? Where are we?
Well, inflation is tangible. Here in Chicago, my Chevy Tahoe, I'm hitting triple digits when I go fill up that sucker at the pump. So we are definitely feeling it. And there's no doubt about it. The Federal Reserve, they were behind the curve. They missed the opportunity to really talk about inflation. They were still buying assets up until the end of February, Robert. That was remarkable. They're still in quantitative easing. So now they have this big swollen balance sheet of $9 trillion. And by design, they were trying to produce inflation. Well, now inflation's here. It's more than they expected. So now they're going to have to figure out how to combat inflation. I think that's a 1-2 punch. So yes, inflation is real. Yes, it's tangible. Yes, we're paying more for food and also fuel, even though the Federal Reserve doesn't really put that into their inflation metric. But what I think is interesting is that I think as we continue to see the economy really reopen, when we talk about the economy reopening, there's been fits and starts. There certainly has. We saw the Delta variant last year. Then we saw Omicron over the holidays. Now all of a sudden it seems like the economy really is reopening. So this inflation, which was partly caused by us having sore thumbs and pressing the Amazon button, we're such large purchasers of goods, that was amplified with the supply chain issues. But I think as we kind of transition the economy from purchasing of goods to more services, I think that's a natural way for inflation to come down. It is at historic records. I'm not denying that. It's the largest inflation readings we've seen since 1982. I know you're probably getting ready to hang out with Mary Lou Retton back in 1982.
I've read about it.
This is just tremendous to see that the Fed is trying to contend with all of this, but they are behind the 8 ball. And I think what happened at the last Fed meeting, they raised it 25 basis points. I think as much as they've tried to flap their hawkish wings, which means they're going to be more aggressive and tightening, I think as much as they want to flap their hawkish wings, they're going to remain dovish. Why? Because they can't have a misstep. So I do think we see 3, 4, potentially rate hikes this year. I'm not in the camp of 7 or 8, but I think it's going to be a consistent 25 basis points every time. I don't see the 50 basis point move. I think that's going to be too aggressive. But what they can do is they can reduce their balance sheet, and that is synthetically a tightening. So I think it's a combination. They're going to be really considerate. But when you realize of all the historical hiccups or missteps that they've making over the decades of the Federal Reserve, I think they're going to be really cautious this time because they don't really have the outlook, the transparency of what those supply chain issues are going to look like finally, what the global economy reopening is going to look like. So there's a lot going into this inflation conversation, but I am in the camp of this. Inflation will come down. Oil prices, we are going to see oil prices be stubbornly above $100 here as we continue to see this geopolitical tension and potentially demand come on from China. But what is interesting is that as we see this transition from goods to services, I think that allows some of the inflation metrics to come back down. And that's going to allow the Federal Reserve to maybe pump the brakes a little bit and not jump into that 50 basis point rate hike, because that could cause some problems in equities and cause a little bit of additional digestion when you see interest rates. I know we're going to talk about interest rates in a second here, but those interest rates have moved dramatically higher, pricing in the fact that the Fed finally is going to do something to combat inflation.
It's interesting. You said something about 1982. And in 1982, Paul Volcker went and talked to President Reagan at that time and said, this is what we need to do. And Reagan, because he needed to get inflation down, said, do whatever you need to do. And what they raised rates eight times.
Well, the Fed fund rates under Volcker went up to 20%, Gil.
Yeah,
and we don't want that. We don't want the
went,
Fed fund rates. I think that would take about 10 years. If they raise 25 basis points consistently every meeting, that would be about 10 years of raising rates. So I don't think we envision that. The Federal Reserve has so many different historical data points to work with here. But I think they're finally realizing that they use the word transitory. Inflation, if you remember Q3, Q4 last year, it's just transitory inflation. And then they finally retired that word because they realized they were wrong. They realized that they really kind of stoked inflation, but also COVID in itself produced additional inflation if it's supply chain issues or if it's simply us really embracing goods like we did across not just Chicagoland, Texas, across the whole globe. We really embraced purchases of goods. So I think that they are up against it. But remember, my view, my opinion, that the Federal Reserve will fall on a more dovish, accommodative side than they will. Inflation's already out of control. We can admit that. But I think inflation is going to run off here a little bit organically. And also they are moving the interest rates higher. They have to be careful on the curve, no doubt about it. You don't want the 2-year and 5-year yield to be higher than the 10-year, 30-year, because that has been a premonition of things to come. Not actually probably usable in this situation since the Fed's never had a $9 trillion balance sheet, but nonetheless, they have to be considerate. And, kind of like Tom Brady coming out of retirement, we're going to see if Fed Chairman Powell can thread the needle on a pass here.
What's interesting about that, and then we'll move on to interest rates is when he raised rates in 1982, unemployment went to 11%. But most people forget about that period of time because that was pretty quick. People started going back to work and times were really good. And in 1996, Nicholas Applegate, I don't know if you remember him, old tech
Sure.
Small cap manager, was in an office giving a speech. And he said, we'll never have to worry about inflation again because the Fed has the ability to use interest rates. He said, you might have periods, but it's not going to be long term. So fingers crossed that they can get this under control and not just kill everything. But that kind of leads us to kind of inflation, interest rates. What's the Fed? Obviously, you already kind of talked about this. They're going to raise. Powell has said that 50 basis points isn't off the table, and kind of setting the curve. You don't think that's gonna happen?
I don't think it's going to happen. I think if you remember what happened, go back to February 23rd, right? February 23rd. That was the high in the stock market in 2020. And all of a sudden, fast forward a month to March 23rd, you saw there's an absolute statement from the Fed Chairman Powell saying, I will be here. The Federal Reserve will be here in perpetuity and unlimited capacity. And that's when they just started buying everything and anything. And I think that's part of the problem that they really created, that, they had to step in, but they stepped in for too long. And typically, we're dealing with academics. You're not dealing with money managers, not dealing with traders. Federal Reserve has theories as academics, but here we are now with this just substantially large balance sheet, and they're up against the interest rates, because this is one thing that's really important to understand, and why I believe that the long end of the curve, the 10-year note, which is at 2.35 today, it recently went up to 2.5%. But I think interest rates stay somewhat depressed or compressed, close to 2% once we get all this volatility and all this rate tightening conversation, not only implemented, but understood and digested, is because they own 1/3 of the 10-year issuance. They own so much, and that's where they've been buying a lot. So if they move interest rates, if interest rates in the 10-year note, which some people are talking about going to 3.5%, 400%, they're not going to do that. They're not going to allow that, I should say, Robert. They're not going to allow that because they're going to have to pay more juice. They're going to have to pay $500, $600, $700 billion a year on that additional interest. So they want to see rates stay lower. They do have to be very considerate of the relationship of the 3-month CD, the 1 year, the 2 year, the 5 year, the 10 year, all the way up to the 30 year. But I think rates do stay lower. But we just all of a sudden saw what happened in 2021, and no one envisioned this. This was my view in 2021. It was a very lonely view. Fortunately, I was right, but I envisioned the 10-year note in 2021 being tethered to 1.5%. And we saw fits and starts. We saw it go down to 130. We saw it pop up to 180. By and large, that was an accurate forecast. But what happened with that being tethered to 1.5%? It's just like an engine, Robert. We see a lot of combustion, coming in, and all of a sudden that torque has to be released somewhere in that engine. And all of a sudden now you're seeing a lot of people, because interest rates, as you know, are inversely related. So the futures market, which I traded the 10-year futures and 30-year futures for over a decade in the pits here at the Chicago Board of Trade. So you see those prices go down, the yields conversely go up. So a lot of buyers got really worried of how aggressive the Fed was going to do. And that kind of was like a string. Once we pulled on that string, all of a sudden it all came out. So we went in the 10-year from about 160-ish to start the year, 155, all of a sudden to 250. That's a dramatic move. So as we digest that and as that reverberations kind of resonate with investors, I think the 10-year comes back down, settles under 2.25, kind of gets back to 2% as this whole rate process or this rate raising forecast process happens. But it seems like every day on CNBC, someone comes on and says, look, we're going to go for 8 raises this year. Oh, 9 raises. Jeremy Siegel's talking about 450 basis point interest rate hikes at the next 4 meetings. That's 200 basis points. I don't see that happening. I think steady as it goes, raise 25 basis points, see if inflation organically moves down, and that's going to keep interest rates somewhat palatable. Historically speaking, we're in a great spot. This is where the 10-year note, I remember 20 years ago, specifically being on my honeymoon 20 years ago. I'm celebrating 20 years this summer with my wife. But 20 years ago, I'm looking at the 10-year note because I had a position on. I shouldn't have during my honeymoon, but had a position on. The 10-year note was at 5.25%, Robert. So here we are, still at less than half of that. We're in a good spot. Businesses are in a good spot. It's just not what we've been conditioned to. We got so conditioned to these interest rates being at zero. We're spoiled brats, to be honest with you. We saw the interest rates as low as they were. So now as we move them back, they did move in a very ferocious and a high velocity manner, but I think it will calm down here in Q2.
Yeah, I think that velocity is what really scared people. You're exactly right. All these things put together, and like you said, on CNBC, Wall Street Journal, Barron's, whatever, Bloomberg, every single day you hear something about recession.
Yep.
You think we're looking at one coming up right here? If so, I realize that it's a fool's game to try to predict it because we won't know until it's already happened, and we'll be out of it before we know that we're out of it. What's your take on recession right here?
I do not see a recession on the horizon. A lot of people come on the CNBC or pick your financial news, and they talk about how the glass is half empty, and a lot of them have a glass half empty and leaking. And we hear the recession word all the time. Well, we saw the inversion in interest rates. Well, historically speaking, and I don't like to use this historical data point because we've never been trading out of a pandemic. We've never seen the Federal Reserve expand their balance sheet to $9 trillion. A fun fact, if you remember, Robert, before the Great Recession of 2008, the Fed's balance sheet was $460 billion with a B as in boy. Now we're at $9 trillion. So a lot of the historical data points that people are using to predict recessions really aren't plausible. But historically speaking, when you do see inversion of the 2-year, which means the 2-year yield is going higher than the 10-year yield, that inversion, typically recession comes 20 months, 20 months subsequent to that inversion. I know we're close to inversion right now, but I don't foresee that. And I don't foresee it because of the growth of the economy. If we look at earnings season, which is coming up on us again here, I get optimistic about earnings season. And if we saw in 2021, you look at ExxonMobil. ExxonMobil made a lot of money for all the reasons we already know. But what did they do with that money? Capital expenditure, increased their dividend, and they also bought back shares. So those three components, I think, have the ability to continue the attraction into the equity markets. And I think all the pessimism actually moves people into a position of vulnerability. And what's been the biggest risk, Robert? You already know this. The biggest risk in the last couple of years is not being invested. We've had every reason, every excuse to go to cash. We've had every reason, here it comes. And right now we have a plethora of headwinds against us. But the biggest component, if you look at you were in cash, if you got nervous in Q1, the last half of March, we saw 11 straight days, the market moved 11% higher. And if you miss out on that, that's the opportunity. So I guess my forecast is I'm constructive, I'm optimistic, but I'm also cautious. I'm being considerate. I think this continued movement out of growth, the high flying FANG stocks into value and in industrials, into boring blue chip names that I love and grew up, enjoying the dividend yield on. I think that wrestling match between growth and value persists. I think you have to have the sectors right. We've seen energy really come back. I like financials, and we're not going to abandon tech by any means. I think if you consider it in tech, cybersecurity is certainly an area that we want to focus on as we continue to see geopolitical tensions maybe transfer into some type of cybersecurity consideration. But bigger picture, I think we're going to continue to see volatility. And I will use the historical data point of the midterm election. Any midterm election year, you typically see a ton of volatility in Q1, Q2, Q3. Once we get closer to November, we get a little bit of certainty. All the gains inside of a midterm election year happen at that point. What's interesting is that outside of a midterm election year, the average gains about 6%. The year after a midterm election. That's where we really have growth. So there's a chart I can share with you, and you can probably share with your clients, but the year after a midterm election, we see an average return of 15%. That's double than any other year outside of a midterm election. I think that's due to the fact a lot of people are repositioning, rebalancing, a lot of emotion in the market, and all of a sudden that next year has the ability to move higher for all the reasons we talk about due to the fact that the economy is growing. But there are a lot of global headwinds. I'm not going to be diminishing any of those potential concerns, but the way we traded through Q1 specific to Russia and Ukraine, potentially China helping Russia, I think it was a pretty resilient market and also showed the appetite that cash needs to be deployed and the market has the ability to move higher.
That's awesome. So just to kind of recap, what you think is that we're clearly going to be in a rising interest rate environment, be very intelligent on your fixed income, that stocks are going to do better than bonds. And you didn't say this, but I'm going to take away that cash would do better than bonds, given what's happening with interest rates inside of there. So we go stocks, cash, bonds, if you're going through to look, but you're still going to have income and security in your fixed income. That kind of making sure that you're moving away from the tech stocks that got us here to staying in tech, but different types and being selective. Dividend paying stocks, things that have earnings that are growing and dividend growing, and being mindful of stock buybacks. And if you're patient, there's times to get in and buy. And at the end of the year, you should be higher than where we were at the end of last year.
I think that's right. And the only thing I would add on to that, and you do a great job when you're building portfolios, you understand diversification. Not every advisor out there understands diversification, but this is a year diversification is so important to the points you just talked about. When you talk about fixed income, what's interesting is that the velocity, that tremendous move higher we saw, kind of that explosion when all that torque was released out of the 10-year note. I think that velocity, the damage in the component of fixed income really dragging the portfolio, I think it happened in Q1. I think we're going to fluctuate around. I don't see the 10-year going above 2.5% for the rest of the year. I think it's going to play a little bit of pong in between 2% and 2.5%. And I think that actually bodes well for equities. Keep an eye on the US dollar. I'm not going to be oblivious. If the US dollar gets above par, gets above 100, that could be a bit of a drag and a headwind. But I do think stocks, to your point, have the ability, but diversification is key. And kudos to you, and a hat tip down to your whole team there in Texas, because you guys understand and have implemented diversification before all this volatility.
Hey, Jeff, I know that you're busy, and I really, really appreciate that. Thank you for taking the time every quarter to do it with our clients. They love it. And several of them are looking forward to the red jacket next Christmas. So we will, I appreciate it. To everyone receiving this, thank you. If you have any questions, give us a call. Sure appreciate it. And y'all have a great week.